Hey everyone, welcome to this March monthly webinar, right? So today, the whole topic of the agenda for today is all about how you actually design a portfolio, right? So of course, we're gonna touch a little bit on in terms of our market outlook, and of course, I'll share a little bit of some of the trade idea that we discussed last webinar. So just following through that, what's the next action plan that I will normally do? Then this I'm gonna share briefly two trade idea around the semiconductor. Just follow up from the last webinar as well. So before we start getting to all the content, so I'm just gonna show this disclaimer. So any result that I'm going to show in the presentation is not a typical result, and of course all the testimonial in here are real, and the result are meant to for the education purposes. And a lot of information that we're going to share here, please ensure that you do your own due diligence and of course use your own best judgment to make any investment decision. So all this content prepare without any consideration of your personal financial situation, and this is for general knowledge only. All right, so let's get into it. First, market updates, right? Last webinar, so we got to the stage of what we call like all-time high, and I did a quick brief sharing of the last webinar. Mentioned, hey, economy looks seems okay, earnings seems okay, everything seems okay. The only we're probably going to see if it drops, right? It's probably just people taking profit, roughly around 5 to 10% max, right? We wouldn't see any huge crash like correction like COVID. And of course, like news is different, like general media and everything you just mentioned, oh my God, it's gonna be a big crash, a recession, blah, blah, blah. But uh, luckily, like in surprisingly in the past few, oh, literally 2 days after that presentation, then the market actually dropped, right? So a few people messages me that, but that's why if you see, follow my Facebook or my Instagram, during the whole situation like this, I'm trying to be as noisy as possible. So noisy means for trying to keep to filter out all the noise, the market noise, especially the drop and everything, the media. So try to get try to make sense of the situation, and of course, like we try to capture the opportunity when it arrives, right? So during the whole situation, did giving update, giving sharing, even in the students group as well, giving my input, my idea, and of course, like the whole process, the whole journey of that 2 weeks is the total drop is around 3.98%. It's not even close to that 5% that, of course, market and media make the exaggeration, right? So that's around overall S&P 500. uh, so this is the overall top 500 company in the US, right? Then after that, the market already rebounded back. It's already reached the all-time high, and it just keep going along and business as usual, right? And but I think the things that are probably quite, I'll say the news is quite escalated, quite big, is due to this. Oh, but before that, but something that we need to think of as well, right? So yes, we see the drop 3.98%. It does happen across that 2 weeks, and it does create a lot of concern. But something that we need to look back as well, right? S&P 500 1 year has gained more than 65%. So something that we need to be compare of, right? So you see the drop, yes, your portfolio might drop that 4%, 5%, but you need to remember all the gain that you're already gain, right? So a lot of things that you see in your portfolio, probably like the portfolio looks red and everything, it might not impact to your original capital. So overall, longer term, your portfolio should be already gone up, right? So all right, so moving on about the news, like in the past few weeks, the recent thing that heated up is more around the technology sector. So this is the QQQ, right? So QQQ is represent the top 100, sorry, 200 company in the top technology company in the US, or not just US, majority in listed in Nasdaq. So QQQ. So they are the one that dropped 11% across that 2 weeks. So in some of my story I did I posted, I'm waiting for that drop 10%, right? So I saw like a lot of opportunity in the different companies. So when it actually dropped at 10%, then a lot of my orders start kicking in and start buying a few positions. So that's didn't actually pick the bottom. I didn't actually pick the bottom. So when it dropped at 11%, the next day when I bought, it's already bought around here. If you see my mouse there, that's the first green bottom. So I'm not actually picking the bottom, but it doesn't matter. So in terms of investing, there's no ego to pick the bottom to sell at the top. It's all about investing for longer term, right? So all about accumulating your wealth and how to try to sustain it. And this is one of the example of, yes, let's say we bought that around here. If you look at that, is it too late to buy it in here or compared to, let's say, buy in the like today, right? So even today, QQQ technology sector hasn't been rebounded back or back to their all-time high. So I'll say there's still so many opportunity around the technology sector. In the early of since late last year, I did mention about I'm moving a lot of my money not in the tech sector, it's moving to different value play and everything. But with this opportunity, of course, like some of the money start flowing back to the technology sector. So start adding my position in the technology sector as well. So I can share what I did, and hopefully that helps in terms of to make sense of the current market. So overall, sorry about my sore throat. Overall, the market still doing well, and of course, there's always going to be noise in the stock market. And I think it comes to us for all the educated investors like you guys that you'll be able to take opportunity on that kind of situation. Cool. All right. So, and of course, drop 11% relatively compared to 1 year. QQQ has gained like more than 80%, right? So if you compare your gain compared to that loss like drop that 11% is meaningless as well, right? And the cool thing with the stock investment, right? Give me a minute. Sorry. The cool thing with the stock investment is once you buy an asset, when you hold it, you don't actually realize the loss until you sell it, right? So if you didn't sell it, then you didn't realize the loss. So even the whole process, it dropped 11%, is just the net worth, just the numbers in your portfolio. And if it's rebounded back, then your net worth could be back to that same last value. Cool. All right. So in terms of moving on, I normally present the economic data and everything, but I look back quick. Oh, sorry. 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 Okay. In terms of economic data, that I did look quickly in terms of economic data. It was the last webinar still echo with what I'm saying. Everything seems doing okay. Unemployment is dropping. Jobless claim is dropping. The property and everything is still booming, and everything, even the prices, business confidence increasing. So overall, economy is still doing okay. So for us, the only thing that we want to focus on is how to be able to capture the opportunity and how we're actually going to design this portfolio. So hence, I think this month agenda is that this month topic is all about designing your portfolio. Let's moving on. So I'm gonna share about our moneymaker trade results. So in the last webinar, I present one trade idea, which is Jinko Solar, which is we sold put for that one contract. So what happened is one contract is required at $5,000. Remember that we sell at $50 put, right? And it's going to expire tomorrow, 19th of March. So during when we did this contract, we do receive $215 for that one contract. That's which is represent ROI at 4.3%, right? So for simple step, 5 to 10 minutes work, and you really receive that ROI at 4.3%. But the situation like this, if you go through our moneymaker course, we did explain when you do sell put on the any of the position, so you are obligated to buy the shares, right? So for this instance, we promise to buy the shares at a $50. So, and when the share price, when we look at the share price currently, right? Current share price is around $44.67. It does below that $50. So what's happening is, since you are promised to buy at $50, what happening and during that expired, you are going to buy the shares at $50. And remember, all the option in US is 100 shares. So in here, that means you're going to buy the shares, 100 shares at $50. That means you need to have a capital amount of money, $5,000. All right. So of course, like a lot of people say, oh my God, my intention is to generate cash flow, Henry. Why I become buying the shares, right? So if you remember in that course, we did mention one thing, right? When we do this strategy when sell put, the whole intention is we want to buy the shares at discount. So for this situation like this, personally for me, is a good is a win-win solution, right? So you already receive a premium, and the second that you already when for this time you bought the shares at discount. In that in mind, for one the next thing that we can do is like I'm happy to hold the shares, right? So, but of course, there's a second thing that you can do to for this Jinko Sol position is you can sell another put option at $40. So this goal is to average it down if we got exercise. So remember we bought at $50. If we sell that, we do another contract at $40. That means your average down is like 50 plus that 40. You divide by that two. You roughly your average price for buying that shares is $45. However, for this step, selling another put, that means you need to come up another $4,000. Cool. All right. The third one, this is a pure cash flow play. This is what we call like sell call options. I'm gonna do a quick recap on what's a sell call option. We didn't teach that in the money maker course, but we do cover that briefly in the course in the video of introduction to stock option. You can have a look at that quickly to just for this webinar. I'm just gonna do quick recap on sell call. Sell call is just represent like you are obligated to sell the shares at the strike price. Remember you when you sell put, you got expired that you already bought the share at $50. Now what you can do the reverse. You can promise them to sell that shares at a $50. So that's what we're going to do for this kind of position, all right? So for Jinko Solar, so remember we sold that $50 put, we bought the share at $50. So what we can do, we can sell the call option at a $50 strike. So the rule of thumb, what I normally do when for the pure cash flow play like this, when I sell call, I sell the strike price is at the price that I bought the shares, right? So which is a $50. Then sell call at $50 strike, that will give us a return at $3.50. That's giving us ROI of 7%. Cool. That for this, you don't need to come up another capital. So you already own the shares. So what you just do is you just what you can say like you trying to sell another contract of this call option that you promise people to sell your shares in the future at $50. Cool. So just a recap quickly. So you can do two things. Sell put at $40 strike that you receive $3. That gives you around that ROI 7.5%. However, you do need to have an extra capital for that $40 strike, which is around that $4,000, right? Or you can just using the current position that you got by selling that call options. So you can sell the shares back at $50. Then you will, in return, you receive that $350, and which is the ROI 7%, right? Something that important when you sell call, ensure that you already have the shares. All right. So number one rule, make sure you already have the shares. You don't want to sell the call option when you don't have the shares as well at all. All right. Cool. All right. So let's move on quickly. So, oh, by the way, that's if you guys have question regarding this support and sell call option, feel free to reach out. Happy to help to guide you guys through for this kind of strategy. And of course, for sell put, it's easy that we can refer back to the moneymaker course video, and that's a cover pretty much everything, right? And even the different scenarios. For sell call option, feel free to reach out if you need help. Happy to help on that one. Moving on, portfolio design. So throughout this process, feel free to stop me if you have any question, and if you do unsure on certain things, feel free to type in the chat. I can see all the conversation in the chat as well. If you miss out something, I can elaborate that more. Okay. All right. So first thing first, what is the portfolio, right? Portfolio is simply just a collection of the asset, right? And the whole this collection is to serve one purpose. And of course, when we design that, they have a specific risk reward profile. So by just looking this brief terminology, right? So the building block to design a portfolio, it comes to these three as well. What's your purpose? What's your risk and reward? And how you're gonna select your asset, right? So it's not that much. It's simply the purpose, risk reward, and asset selection, right? So in terms of the portfolio, right, we'll start with the purpose, right? Majority of the purpose when design portfolio, if you heard people out there they're talking about bond, they're talking about the stock market, but talking about property. So all this comes to two categories, right? Either income, which is the cash flow, oops, or the growth, right? Which is your capital gain to growth, have a growth strategy. So your purpose, it doesn't mean to be either one. So can be a similar like dial, right? So you can say like you say, hey, I want my whole portfolio is start with just a cash flow portfolio, right? That means 100% in the cash flow, which is what we teach in the money maker course, right? Or you can say, hey, I want to turn the dial into the more on the growth portfolio, right? So that could do as well. And of course, it doesn't mean that it need to be one end or the other end. And it can be tweaked into, let's say, hey, this can be in the middle. All of them mostly depends on your life stage and net worth as well. Just giving example, right? So if you have lower than a 50K, so that means you could do majority of your portfolio into 100% growth, right? So if you think about it, will you be able to retire just from the cash flow of the 50K? Most likely no, right? So that of course the whole intention when you have the portfolio quite small is how do we be able to grow your portfolio as fast as we can, as much as we can into the next stage, right? What's the next stage? It depends on your like living expenses and everything as well. So for our pure example, lower than 50K, our goal, we want to grow the portfolio as fast as we can. Then that means that the focus is to get that focusly on the growth, right? In Turtle Investor Academy, in our portfolio, we do have this rough structure with this purpose, right? We have 80% growth and a 20% cash flow, right? So for some students, I will explain briefly how we break it down later on. So 80% growth and a 20% cash flow, right? The whole intention of cash flow, just briefly touch in here, is represent our cash allocation roughly, yeah. And so it's 20%, which is cash allocation. And of course, we do teach a money maker strategy around selling put options. And if you look back that course, selling put option require a cash, right? So what we do is rather than cash sitting in our portfolio doing nothing, so we try to utilize that cash as much as we can. So one of the safest and the easiest way for us to do is to sell a put option, then it will generate a cash flow for us, right? So these are cash, mostly we use it for, I would say like ammunition when there's the market correction, like recently when QQQ dropped more than 10%, then I use some of the cash to buy more shares or buy some call option as well. So that's 20% cash used for as well, for cash flow roughly, right? So in terms of our portfolio in the Total Invest Academy, category-wise, the purpose is 80% growth and 20% cash flow. Hence, if you see our portfolio tends to grow really, really fast when the market doing really, really well, right? So in terms of moving, the next one is we're looking for about the risk and reward, right? Risk and reward is very simple. It's all about how much you are going to lose if you are wrong, or how much if you're going to gain if you make money if you are right. So now that the most important for us is to find a balance, right? And my focus in our Total Investor Academy portfolio is how we be able to make our wealth sustainable, right? And hence the portfolio need to be designed to handle when we are wrong. We already built a lot of I'll say like defense mechanism to finding analyze the company, finding the right stocks, and applying the growth strategy and everything's. And if everything's right, and if we are right, the gain or the profit is a byproduct. It will come eventually. Of course, when we put this all the strategy that we have is buying call options, selling put options, or even just to buy the shares, it's all have a different purpose and they designed to handle when we are wrong. Cool. Hence, there's a few things that comes to picture when a lot of people are going to talk about risk reward. Is the first thing is comes to mind is the diversification, and I think you heard that from the bank or everywhere. Don't put all your egg in one basket, right? And that's just a simple metaphor of the diversification. But we'll go through in terms of our stock portfolio is diversification about like how many stocks we're going to have in a portfolio, right? And of course, each depend the total position, the total stock that we have, it will have a different risk profile. And just giving a quickly here, so bear with me. It's gonna be a lot of numbers and it's gonna be a lot of calculation, but I'm gonna summarize that at the end as well. So you have in here in the first column, total position, you have risk percentage per position, and you have a risk difference on each of the total position, right? So just a rule of thumb, we just use that 1 to 25, not going to do too much. And so when you see that's the risk difference, every time we increase the total position, it does the risk it does reduce. However, we start encountering what we call a diminishing return, which is the risk difference between extra position is not really helps. It's not like giving a lot of benefit when it goes more than, let's say, 15 to 20 or 25, right? So if we look in terms of the chart aspect, right, we looking what we call like diversification risk profile. So risk, the blue line risk percentage per position, red line which is risk percentage difference for each position. We start seeing that when it getting closer and closer, is which is around when it risk is getting lower than that, I would say like 20-30% is where roughly around this bracket, right? So roughly around 5 to 15 position, you already reduce a risk a lot, right? So if you look in terms of in like total position of 20 and 25, your what you reduce the risk difference is not as big as when you have, let's say, when you reduce from, let's say, from three, like increase from 3 to 5, right? So that's why like we were looking, this is roughly the sweet spot based on the diversification risk profile. And of course, like we want to look at different scenario or how this can affect when we have a different scenario, when we have certain stock gain so much or when a bankrupt, right? So we're gonna go through a few scenarios. Let's say we have starting value of 100K. And the first scenario is, let's say you have two stocks that you're gonna lose 100%. Let's say, I don't know how you're gonna pick that. Somehow we're very unlucky. We pick two stocks, is all went bankrupt, right? And the rest of the company, we make a profits. Let's say we don't pick a right one, the profit is not much, right? Roughly 5%, all right? So just FYI, average return for the US stock market roughly around 10%. Right? Let's say we pick a lot, we pick really bad, right? We only pick, let's say all the stock that we pick only generate 5%, the rest 5%, and we release shit and we pick two stock like lost 100%. Make sense for the first scenario? The second scenario, let's say we pick two stocks that we pick the one stock, right? Like two stock that we pick gain like 100%. The rest of the stock we're not that lucky, so the rest of profit like around that 5%. So we use these two scenarios. Like first scenario we lost a lot, and the second scenario we gained 100%, right? So bear with me. This the left one is when we have the company that we lost so much and lost 100%. The right table is all about represent how much for the two stock that gain 100%. Just explain a little bit in here, right? This is the left hand total position, and then after that we're just looking how much the return difference if we increase the position. So how much risk that we can reduce roughly, right? And in here the right one, how much apparently like when we increase the position for when we have, let's say, two stock that gain 100%, the more we increase the position, our return is reduced a lot more as well, right? So then we want to see that how much the return difference when we start increasing that position. So in here, we just like plotting in terms of the blue line, which is the stock that gain like 100%, and the blue line, which is gain 100%, red line, which is the stock that which is lost at 100%, right? Just looking at this, we want to also like we want to find the sweet spot where the difference of our performance for each of the increasing the position is not giving a huge numbers, right? So I use the number roughly around like starting that drop around that 2.5% variance. I'm happy with that. So I put that sweet spot around here, which is around roughly 10 to that 20 stocks, right? And I think everyone needs to remember, the more company that you have in your portfolio, that means you have more work to maintain that, right? So you need to think of like your effort compared with the how much that benefit that we will get based on risk reward as well. So just to summarize quickly, based on that risk profile and that return difference, so we put that sweet spot roughly around 10 to 15 positions. So hence, if you in most of our students in the Total Investor Academy, we teach people, hey, roughly we try to target like around that 10 to 15 position. The more you have, that means the more work that for you to maintain your portfolio. The less you have that 10, the riskier that you will have in terms of your portfolio. Of course, everyone has a different risk profile. We'll come back to that very soon. And the next thing is a lot of question is how much allocation percentage for each of the position, right? Which is known as a position sizing. For education purposes, for general rule of thumb, we're looking for equal weighted. So let's say we got 10 stocks. So each, let's say total position is 10, each position is around 10%. So we make it as balanced as possible. Cool. So this is this the goal with this one is no much bias when you select the stock. So it doesn't mean, let's say I like, just give me an example. So let's say you see, oh, I like Apple, then doesn't mean like I from that 10 companies, I put Apple probably 20, 30, 40%. The rest is just a lot smaller. So we try to make it as balanced as possible. Remember the first rule, you need to know how much you're going to lose if you are wrong. What happens if you're wrong select Apple, right? So that's, I think you need to have a balance. It comes back to your risk profile again. We'll touch a little bit shortly. And the lastly is all about asset selection, right? And of course, in our because our portfolio is, we are talking about a lot of with the stock investment. Our asset is the stock market, which is the shares, and of course you can balance it out with your asset selection with property, with other things as well, or bond, or which is a term deposit or cash. That's considered an asset as well, or even gold. or silver. Some friends are into that gold and silver, so you can do that as well. So asset selection is choice, but for our education purposes, this webinar is going to discuss about the stock, right? For the stock market, we do have a few category, which is what we call like a sector, right? Which is a sector profile. A group of stock, they tend to follow a certain sector or industry. So we group them based on the sector. Each of the sector have a different profile, right? So this is the data since that 2007. So the sector is here is the annual performance every year, and this is how much the best performance for a year, and how much the worst, how much the drop that will do the worst drop within that year, which is like minus for example financial around minus 55%. This is roughly around GFC time, right? So based on this, if we look at this, I want to pinpoint it here, right? So if you look the worst numbers, which is around that the bottom three, that's less than 30%, right? So anything that less than 30%, they tend to be what we consider a defensive sector. So if you heard a lot of news about it, talking about all company stop moving from the aggressive like consumer discretionary or consumer physical sector into the defensive sector, right? So this is what they're talking about. So a lot of stock moving to this utility, healthcare, and consumer staples, right? And I do have a few people that question my portfolio, like, Henry, how come your portfolio doesn't have a lot of like technology sector or like other financial and materials and bunch of other stuff, right? But your performance still beat the whole stock market. So if you look at this bottom three, right? You have a utility, healthcare, and consumer staples. If you look at the annual performance, right? If you look at that, the annual performance is more than 10%, but the drawdown, the worst drawdown is less than 30%. So if you look at risk and reward, they are not that risky, but they do have a stable growth over the longer time period, right? So of course, you might not be able to see like the best performer like in the technology sector, like in 1 year, it will jump like 61%, just briefly, right? You might not able to see this kind of gain with this defensive sector, but it comes to your risk profile, right? If can you handle the drawdown of, let's say in here, drawdown of 40% or 50%? If not, probably that's not the right sector for you, right? So if you see that, I remember I mentioned a lot of my portfolio before. I do have a lot in consumer staple and healthcare. If you see that there's a lot of annual gain in here, more than that 10% as well. All right. Don't get me wrong, I do have a few technology sector as well in there, but it's not like all of the company in the portfolio is a technology sector, right? So a few people asking like, how do we find the company under this sector, right? It's quite simple. In Yahoo and everything, you can search that whatever the company name, search let's say Nike sector, and it will tell you what's the sector. If not, there's a simple way to use a screener, which is you can filter by the sector, right? In here, this is what we use FinFish. FinFish, you can, this FinFish mostly for US stocks. You can go to FinFish, there's a screener and the sector, you can search them. So in here, they don't have a what they call consumer staple, but they call it consumer defensive. They are similar. So you can look at that. It's consumer defensive. That is the which is the consumer staples. Healthcare is the healthcare. So it's the same. So once you do that filter, you will know like all the companies within that sector. So if for people that quite new with this investment and everything, it will help you to find the company or start the research, right? Of course. And what we want to do, let's want to start putting all together, right? So just giving a realistic example. So you have people that have a portfolio set of 10K. Let's say their risk profile say, hey, I can't handle, I don't want to have a drawdown more than to 20%. So then of course they want to have a target return at 10% per year, right? I just want to have a market rate. Want to get a bet similar with the average market of the past 10 years, which is around 10% per year, which is okay, right? So you can look at the portfolio design. Since your portfolio start with that 10%, 10K, of course, your goal is try to grow as fast as you can. And the first purpose is to find a growth, which is that a fully allocation of the growth 100%, right? And the total position is want to be have a more than a 10 stocks. So based on that risk profile that we got before, the less than total position, your risk proportion is a lot bigger, right? So you can, if you take a screenshot of that today's presentation, you can look back quickly. So based on that table and everything, so roughly the total position for this kind of people is looking for more than a 10 position, right? In terms of asset selection, we start looking for this portfolio, looking for more around the healthcare and consumer staples. So when I say like asset selection, healthcare and consumer staples, doesn't mean the whole portfolio just these two. You can, once I say like healthcare and consumer staple, that means you will have a more weighting. So that means you have more of your money into these two sectors. Make sense? Cool. So let's move on to the second example. So similar portfolio size, but your risk profile, this guy is more more greedy. So and happy to handle the risk. I say, hey, I can handle the drawdown more than 30%, and but I want to target return on like 20% per year. Of course, like that's still reasonable. So come through that portfolio design, similar. Try to grow as much as we can. I would just grow 100%. The total position, he can it can handle like more than four. So even like four company in the portfolio is totally fine for this kind of people, right? And of course, in terms of the asset selection, since he or she can handle more risk and looking for higher return, then we start looking for the sector around that technology and consumer dictionary. Make sense? Cool. All right, so that's a two example regarding our portfolio design, how we just roughly put it together. In terms of portfolio return itself, right? All previous example regarding the return is all based buy and hold shares. And we do teach people in terms of option strategy, but our technique is very different, which is we focusing with the long-term holding in mind. So in just a few things like our free mini course, we teach to generate around 20 to 30% per year. And our full course students, this is just the past return, right? Remember, past return doesn't guarantee your future performance. Our past return can generate some 50, 60, 80, or even 150% per year. So it depends on how much your allocation, how you design your portfolio again, right? So so everyone's different. That's what we teach in terms. We do have a general guideline how to design that, but everyone have a different situation. That's when we have a coaching session where we tweak your portfolio based on your financial situation and your personal objective as well. Cool. Any questions so far for around the portfolio design? Almost time, almost finished. All right, let's move on quickly since the time almost finished. So around the semiconductor, I'm gonna do a briefly, all right? So last webinar, we touched a lot with the boom of the semiconductor due to many stuff around the semiconductor, which is the chips, right? For the technology for a car, your mobile phone, earphone, or laptop, a bunch of other stuff. And even like that graphic card and everything, or your gaming is using that semiconductor, which is chips. So the reason that the boom of the semiconductor due to two things, right, is high demand from many innovation industry, and we have the recent news everywhere is we have a supply shortage from a lot of manufacturer. So by combining these two, and you have if the shortage, the supply is not fixed, that means your other innovative industry will be crippled. So hence a lot of government and everything try to boost the production, but the semiconductor try to fix the supply chain and everything. So there's are a lot of support to make the semiconductor company to be successful, right? So hence we do look a lot of ideas before last webinar, so more like supporting information. So today I'm going to touch two ideas that I just I come across and I'm quite interested with them. So these two ideas I'm going to share briefly. And what we do is I'm gonna post that in our Facebook group, and we're gonna kick off that discussion over there as well, right? If you have input regarding this two company, we'll start that discussion. Have post your insight, post your ideas and your finding and everything in the Facebook group. So we'll do a quick discussion on this company. But before we start that, I'm gonna do a quick brief. The first one, which is the STM, which is STM Microelectronics. So this is quick glance in terms of semiconductor, which is chips, right? Like let's say one phone in here, they might have thousand or more than 10,000 chips in here. So they do have a lot of sensors, a lot of things, even the how to turn it on, your what do you call your GPS and everything a sensor which is using the chips. So there are a lot of category in here, so I can't cover a lot of too much detail in here. So in overall, each of the big company around the semiconductor, mostly they are leader on certain category. So in here we do STM, they are start getting popular around the mobile memes, which is like Apple earphone and everything, sensor and everything, they are memes and like sensors. A lot of in here about hard disk and everything, and even the what do you call solar panel and everything come from these chips as well. So they are in a certain category, they are number one. And of course, this is just a briefly around their strong position across all of the end markets. But if you look in the numbers wise, right? Earning per shares in 2009, everything is start growing. We haven't got the 2020 data, but briefly, I did check quickly. It does goes up. So overall trend, it does going up. Net margin, they are quite on fire. They are growing. For the semiconductor, quite competitive. I'll say very competitive industry. For net margin, that quite high like this is considered like really great, right? So cash flow growing, which is good. The efficiency is a bit touch wood there, that's okay, which is taking our criteria. Not much debt, which is good. And they even the whole operation shutdown and everything, they still have money to pay all that short-term obligation, which is the discount ratio. They can handle more than 2 years, right? So just looking at this, we do have a business score around like 7.1. So anything that around seven seven and up. So we are considered okay to invest, right? So in terms of price point as well, around like $36.99, they're still affordable for many people. So we do for booster strategy, we do be able so for buy call option, we do be able to get to the break even roughly to move that 12%. The share price need to move 12% within that 2 years to get into the break even. So this is one something that you can do. And the second company, which is this is German company, the Infineon. So Infineon has a quick glance, right? If we're talking about a lot of automotive, a lot of adapt, advanced adaptive driving system or something else. So they are considered a leader in that. So if you see that a lot of their revenue come from automotive, if you see that 43% come from automotive. Of course, there are the other area that are getting boost as well from the other leader of this industrial power control. And I think the one that is quite high, which is the market leader in this category, which is the power and sensor system. So in terms of the numbers, they are focusing IoT, which is quite popular with the sensor, with the also the fridge, your smart home, smart city, and everything that IoT stuff. And yeah, so this is Infineon. And numbers wise, so they do have a big drop in here around that 2019 and that 20. So look into overall trend. I did a quick research, it's just a brief research. They do a lot of expansion, hence they're increasing debt recently in that 2019 to 2020, and the EPS drop as well. So which is totally fine for this growing industry. But of course, we taking this a consideration with drop and everything, the business score still around 7, right? So just if you look at this, for Infineon, they are listed in the German exchange. They have a December 2025, right? So here is right? The share price need to move roughly around 16% to break even in 4.5 years, right? So let's say you buy this position, let's say call option, you can sit there doing nothing for 4.5 years, right? Of course, if it does reach the 100% profit before that 4.5 years, of course you can take that profit, all right? So this is just two idea that I got really interested. Haven't got so much vision on that yet, but of course I'll share that in our Facebook group and to have that kick off that discussion as well. All right, cool. Yep, thumbs up. So Q&A. I'll give you guys 10 minutes. Like if you have any questions or anything around the portfolio, anything on the market and everything, feel free to ask here and I'll try to answer as much as I can. Oh, one more thing, I just remember. Move back, move back. STM. This company, part of my research briefly. So in the past 1 and 2 years, they are very focused on trying to grow a lot of their business into the automotive as well. So if you do a research on this ST microelectronics, they are trying to grow all the about the car sensor, LiDAR, ADAS, and every bunch of other stuff around the car. And they are considered as one of the highest growth in that category. So they are both company. That's why hence I got that very interested in these two companies. Cool. All right, move back Q&A again. So yep, Ida asking, do you sell in your buy and hold portfolio? Yes, Ida, I do sell them. So normally I sell them majority when I buy the shares, I normally already have my investment thesis for holding that shares, right? My investment thesis, let's say, based on let's say the growth sector, based on the fundamental and bunch of other stuff, or based on the businesses, right? That's mostly the reason I invest in the company. If they have a strong competitive advantage and everything, I invest into them, right? If that investment thesis change, which is let's say somehow they lose the big customer or they lose the market share or they do a lot of acquisition which is doesn't have a synergy with their current business, then that means your investment thesis is impacted, right? That means it changed. So I normally do reassess that position. Then if they are completely changed, I drop everything of that company. Make sense? So that's tend to sell because of that. The second thing that I tend to sell because I find a better opportunity probably around the same sector industry. So just giving example, right? So let's say I have a other semiconductor around cars as well, right? And start realizing that in the past 2 years, SDM, which is the one that booming, right? So if I do research, I do measure, which is STM is a lot better with the current one that I have. I might sell the current one and just buy STM. Make sense? Okay, cool. Yep. So Yan asking, low capital says 50K to start. Does it mean playing option is not a great way due to it's only giving us cash flow? Okay. In terms of the option, there's a similar with the remember the portfolio purpose, we have a $2, right? So you have a cash flow, which is what we teach in the cash flow a money maker course. And of course, we do teach about the growth strategy in our full course as well. So when you do, let's say you have a 50K to start and if playing options and your goal is to grow your portfolio, then the best choice for you is definitely try to get into the growth strategy. But of course, if the knowledge and everything is limited, which is you only know about using the cash flow strategy, and I think something that you need to weigh in, right? Is it better to have a return at the cash flow, which is having a return at 20% per year, or is it better just buy just and hold that shares, right? If you, let's say, depend on the stock selection as well. Remember the asset selection. If you select the stock very conservative defensive sector, then might just be giving a return at 10% per year. Probably best to have using a cash flow to generate that roughly around that 20% per year, right? Just conservatively. Sense? So the thing that comes to your asset selection, your design, and your purpose as well. Short answer: you have you have a growth strategy using option as well. Cool. All right. Another 2 minutes, then we're just gonna wrap up the whole presentation then. Hi David. You're asking where can I find the cost for short selling in IB? Well, we don't do short selling in our academy. However, if you're looking for the cost, the financing cost, the overnight cost, and bunch of other stuff, you can check. Probably the best is definitely go to IB website, the interactive broker website. They do have fee and commission, and you can look in terms of how much they charge overnight. And I know what I believe is I checked briefly before. They are considered as quite cheap because they only put a little bit more. I think they put like 0.75 on top of the current cash rate. So I'm not depends on the stock where you invest to. So if you start selling in the US, then they will just charge that whatever the cash rate in the US, then on top 0.75% roughly. Cool. But in our academy, we don't short selling. Cool. Yeah, 1 more minute. Cool. All right, guys. If we don't have any more question, I'll just wrap up tonight. And if you do need help with things and regarding the portfolio design or sell call, feel free to reach out. Happy to help you guys as well, right? And oops, got another one, no question. Team asking portfolio sizing for ETF, right? Really depends. Team, is it the ETF for the whole portfolio is ETF, or is it just one ETF for the one portfolio? Okay, so just briefly, right? Depends on the ETF selection. So just giving example, I used to have what we call let's say I used to have the Square. I do have a PayPal before. So if you looked at Square and PayPal, then I do have I do have Square. I do have a PayPal before. Then I do have then I look in terms of some ETF, let's say ARK ETF, which is ARK fund. They do invest into Square and PayPal and everything as well. So what you can do, let's say you put Square 10%, PayPal 10%. What you can do instead of that 20% in those two companies, you can put that 20% in that one ETF. Make sense? Or the simple way, like I said, the simple things is equal weighted. Consider one ETF is one position. So it's something that probably straightforward, simple for everyone. One position, one ETF is one position, is equal weighted for with the rest. Cool. All right. No more questions. All right. Thank you guys for tonight. I think time for me to have dinner. As you heard about the small arm before. So have a good night, and I'll catch you guys next month. And yeah, any question, feel free to reach out. Good night, guys. Bye. See you.